It's been a rather volatile few months in the stock market. In this video, I'll be showing how my investments are performing. I'll be going through all the different sectors and I'll be revealing everything I've been buying and selling this year. There will be full transparency as I have a record of every penny I've put into my Barclays platform and I've never taken any money out. As always, none of this is financial advice. I've been building my dividend portfolio since 2009 by investing spare money each month into mainly large cap UK companies who pay reliable streams of dividends. I reinvest the dividends and let them compound over time. Some investors prefer growth companies or only invest in index funds. I'm aware that what I do may not outperform or even match the market in the long term, but we don't all have the same goals in life, and what one person finds motivating and fulfilling, others may not. About a year ago, I released this video on premium bonds, which over the last decade would have given you a miserly return of only 1.3% a year. Yet despite this, that video has been my 5th highest in terms of likes, and my 2nd most watched video with over 99,000 views. With shares, my aim is quite simply to grow my average tax-free monthly dividends year after year to see where this journey takes me. I'll go through each sector in ascending order of performance this year. In the chemical sector, I only have one company, Croda. It's had a terrible time recently and I've only started buying it this year, as I think it will do well in the long term when the economy recovers. Its dividends are low, but they are very reliable, and Croda is one of those companies which have a track record of growing their dividends year after year. As I go through the slides, this figure shows the average year-to-date price change in the companies I hold in a given sector. It's only based on the companies I hold and not the industry as a whole. This figure shows my current holding. This figure shows the price change this year, and because Croda is the only company I hold in the chemical sector, it will be the same as the figure at the top of the screen. Finally, here is how much the company pays out each year. So in this case, I have £4,400 invested in Croda, so I would expect to receive a dividend of around £70 a year. The next worst performer is the insurance sector, down nearly 27%. Aviva returned some capital to shareholders early in the year, so this probably looks worse than it actually is. The yields look high, and I'm a bit concerned about the sustainability of Direct Line's dividend. In the retail sector, I own Tesco, and it's down 24% this year. I think it's a safe bet over the long term, so I'm happy to hold it. The banking sector is down 10% and I have 4 companies. Quite different stories for these two, with Barclays dropping 23% so far this year. HSBC is doing much better. Lloyds and IG have higher dividends, but the shares have both fallen. Profits in the banking sector, however, should be helped by the rising interest rates which we are now seeing. Down almost 10% as a utility sector. I've held both of these companies for over a decade. They pay a dividend of around 5%. In times of recession, the utility sector tends to fare better than most. The water company United Utilities is also well down on the year. Now for the consumer goods sector, down 7% overall. I have 3 companies in the sector, including the global giants Diageo and Unilever. As you will see later, I've been buying plenty more shares than these two throughout the year. They should continue to churn out reliable dividends for many years to come, as well as having a great track record of growing their dividends, as you can see here. For more charts like this, why not check out the website Dividend Max? It's absolutely free. Haleon is my 3rd company in this sector, and I acquired this recently when GSK split into 2 companies. Here are some of the brands which Haleon makes. In times of recession, consumer staples tend to do better than most. Next is an exchange-traded fund. This one tracks the S&P 500 and is down 6.6% this year. I've been buying it on a regular basis for a bit more global diversification. Another ETF now, and this one gives you exposure to the whole FTSE 100 index, and I buy this when I can't see bargains elsewhere. In mining, I only have Rio Tinto, which is down slightly this year. The mining sector can be extremely volatile and is definitely not for the faint-hearted, but I'm happy to hold Rio for the long term. Up 1.4% is the renewable energy sector. Bluefield specialise in solar power but are also branching out into wind and battery storage. Greencoat specialise in wind energy. The 3rd company I have in this sector is the Renewable Infrastructure Group, and they have wind as well as solar assets. Whenever I see those spinning blades, I think of money being made out of thin air, and some of that money is flowing back to me in the form of dividends. My newest holding is an ETF with the ticker code VHYL. I'm primarily a dividend investor, and this ETF gives me global diversification as well as a stream of dividends from companies from around the world. The yield is 4.2%, and I'll definitely be buying plenty more of this one. The aerospace sector is up 6%, very mixed fortunes with these companies, with BAE Systems doing well as many countries bolster their military defences. Rolls-Royce is closely linked to the fortunes of the aviation industry, but I've been buying more this year as I believe air travel will eventually return to normal. The third highest performing sector in my portfolio is Big Pharma. I have two companies, AstraZeneca and GSK. I've been buying more GSK recently as I see it as a more efficient, streamlined business. The food and tobacco sector is up 12.4% this year. The shares of both of these companies have risen strongly, and they pay large dividends on top. Tate and Lyle is down on the year, but it has sold some businesses and returned money to shareholders. And the highest performing sector in my portfolio is oil and gas, up an incredible 44.9%. This is one reason I like buying individual companies as well as ETFs. During the pandemic, the price of these two plummeted, and I started buying more. Since then, they have recovered strongly and have been the main driving force of the capital growth in my portfolio. Now I'm going to reveal all my purchases this year, and all I ask in return is a quick tap of that like button, as it really helps out the channel. Thank you. With my shares now paying well over £1,000 a month in dividends, I don't always have to put new money in. So here are all my additions to the portfolio this year. I've been buying more Unilever than any other company, and I also see Rolls-Royce as a bargain. It doesn't pay a dividend, but may well do in the future. Now, because Shell and BP have done so well recently, I've had to give them a bit of a haircut to rebalance a portfolio. There are going to be times in the future when there will be an oversupply of oil, resulting in a lower price. It's a cyclical stock, so it makes sense to give Shell and BP a bit of a trim. Cash in the portfolio sits at just over £5,000. Since my last update about 2 months ago, the portfolio has increased by over £11,000, but I did put £5,000 of new cash in. So this gives me an actual gain of £6,649 in 2 months. So how have I done this year so far? Well, at the start of the year, the portfolio had reached just over 301k, and this November it's at 353k. 16k of new money has gone in this year, so despite all the volatility and panics in world markets, my portfolio is showing a gain of over 35k this year, or a return of almost 12%. I'm now going to compare the performance of this portfolio with other indices. To do this, I'm going to strip out any dividends I've received this year. This still gives me a gain of 7.9%. You can see in this table how the performance compares to other indices. A word of caution, however, I've clearly beaten the market this year so far, but that doesn't mean I will over the long term. Oil has done incredibly well this year, but there will come a time when it will underperform. So what about my overall performance since I started? I made plenty of mistakes, particularly in the early years, and I was restricted to buying UK individual companies on my platform, and ETFs were not mainstream. In total, I've drip-fed £225,000 in, and if I were to sell everything today, I'd walk away with a gain of £128,000 profit. This may sound a lot, but I've still underperformed certain index trackers in this time. So if total return is what you want, then make sure you consider a simple low-cost index tracking ETF, and don't simply follow what I do. I'm just showing you my own journey. It's not the capital growth that motivates me to continue year after year. I've no intention of selling as I'm a long-term dividend investor. Watching the average monthly dividends grow is the thing that keeps me going. As the passive income increases, it gives you options on how you spend your time. Today, my average monthly dividend income is £1,149, and because I use a stocks and shares ISA, it's completely tax-free. Now, what will I do in a market crash? Click up here to find out.